In this video, we're going to discuss actuarial operations. This is from Chapter 7 of the CPCU 520 text. We'll start with a look broadly at the actuarial function by looking at 4 different general characterizations of the actuarial function. Essentially, through the actuarial function, we put a price tag on risk. This is where the insurance company determines how much they will charge for assuming the risk of others. It deals with the financial impact of risk only. There are often many other impacts of risk. When you have a car accident, when a family member dies, or when your business is sued, there are often many consequences that cannot be measured financially. So putting a price tag on risk only means in terms of the cost of having a loss, or assuming risk. It can be thought of as where the business of insurance meets the math. If you're interested in becoming an actuary or just interested in learning more about actuaries, I would recommend going to this website called Be an Actuary. It not only has a lot of great information about what actuaries do, but it also goes through the process of becoming an actuary. Additionally, the actuarial function uses data mining to develop an insurer's predictive models. Generally speaking, data mining, sometimes called data or knowledge discovery, is the process of analyzing data from different perspectives and summarizing it into useful information. Information that can be used to increase revenue, cut cost, or both. This information comes from the website shown below. Data mining is becoming an important part of every aspect of business today. But as you can imagine, it is especially important for insurance companies who depend so heavily on data and prediction to effectively use data mining in their business processes, especially in their actuarial function. In addition to pricing risk, actuaries also analyze reinsurance models. When an insurance company purchases reinsurance, it changes its total risk exposure. And so part of the determination of the price of risk must include any reinsurance that the insurance company has purchased or is considering purchasing. They also estimate future cash flows to make sure that claims can be paid by setting up reserves. They test surplus adequacy. We've talked already about the fact that insurance companies are required to carry a certain amount of surplus, and that surplus is an indication of the insurer's capacity to write more insurance business. Actuaries have the responsibility of making sure that surplus is adequate. Additionally, actuaries are responsible to submit financial information to regulators through Schedule P of the insurer's statutory financial statements. Schedule P is also known as the loss triangles. And finally, actuaries participate in corporate planning. While some insurance companies primarily use actuarial consultants rather than actuaries, for those companies who do use actuaries on staff, the actuary generally holds a very high place in the decision-making of the insurance company. Let's now look generally at actuarial services. As I just mentioned, large insurers generally employ many actuaries, whereas smaller insurers often use actuarial consultants, and some larger insurers will also use actuarial consultants, sometimes just in certain lines of business where their own actuaries do not necessarily have as much expertise. An actuarial consultant might be a subsidiary of an insurance company broker, or a subsidiary of an audit or accounting firm, or they might be independent. You can find more information on actuarial consulting firms and actuarial careers at this website. Let's look at an excerpt from this website. These are some of the actuarial consulting firms. Let's look more closely. Willis Towers Watson is one of the top actuarial consulting firms in the world. It was formed as a merger between Willis Group and Towers Watson in 2016, where Willis has long been one of the largest primary insurance brokers in the country. Towers Watson was itself the result of a merger between Towers Perrin and Watson Wyatt, both very large accounting firms as well as actuarial consulting. You can see from this list below that Willis Towers Watson provides actuarial consulting services in many areas of the insurance world. as well as other services like change management and determinations of executive compensation. Aon Hewitt is actually a subsidiary of Aon, which is the country's largest primary insurance broker. As you can see, in terms of actuarial consulting, it traditionally focused on the retirement and benefits sector, but it has been expanding into the property and casualty practice as well, though it is still small compared to Towers Watson and Milliman. Milliman is one of the largest pure-play or independent actuarial consulting firms, and again, as you can see, they provide actuarial consulting services in many different aspects of insurance. The Big Four audit firms are Ernst & Young, PricewaterhouseCoopers, Deloitte, and KPMG. All four of these have large consulting practices that include actuarial consulting. Now let's discuss rate-making goals. We know that rates must be adequate, not excessive, and not unfairly discriminatory from our discussions of insurance regulation. But what about specifically from the perspective of the insurance company? In order for an insurance company to be successful, the rates that the actuarial staff sets for insurance policies should be stable. In other words, they should not fluctuate greatly. They should be responsive to change. In other words, if the risk changes, the rate should go down or up to reflect that change. So for example, if I'm talking about commercial auto, rates are usually based on the number of trucks or cars insured. This makes them responsive to change because if I add an auto to my fleet of vehicles, I am increasing my risk exposure. Rates should also provide for contingencies. In other words, rates should allow for you to be somewhat wrong in your guess about losses. Additionally, rates should provide for contingencies like disasters, hurricanes, earthquakes, and other unexpected kinds of losses. Rates should also promote loss control. For example, rates might be discounted for things like using fire suppression systems, training your employees, and of course, for past loss experience. Rates should also be simple. It's important for rates to be simple enough to be able to explain to policyholders. Especially when it comes to producers, policyholders want to know why their rates have gone up. So rating factors should be generally understandable to policyholders. And rates should reflect differences in exposure. Similar to being responsive to change, rates should be reflective of the riskiness of the underlying insured. So property owners living on the coast of Florida should have to pay more for their wind damage coverage generally than property owners living in central Georgia. This insurance company, AHT Insurance, publishes these examples of insurance coverages, their exposure basis, and typical rates or premiums on their website. Let's look a little more closely at each one. Notice especially the exposure basis for each one of these types of coverage and think about whether each one of these is reflective of the riskiness of the underlying exposure and appropriate for the coverage it provides. So let's first look at property insurance. The exposure basis is the replacement value of the property, which usually becomes the limit of insurance. It makes sense that this is reflective of the riskiness of the exposure. Similarly, with inland marine, the exposure basis is the value of items insured. With liability, the exposure basis generally becomes a bit more complicated. With any property coverages and inland marine and ocean marine, the exposure is limited to the value of the property being insured. But as we know, since liability is third-party coverage, the exposure basis is really not limited. It's dictated by the amount of damage you cause to other people's property or bodily injury by your own negligence. But one way of setting the exposure basis for general liability and errors and omissions is the revenue of the insured. With general liability, as we've discussed before, another way is total payroll. The idea being that the larger the revenue or total payroll of the insured, the greater their exposure to a negligence lawsuit. It does make sense that workers' compensation should be somewhat based on annual payroll, since a significant portion of the workers' comp exposure is the indemnity or replacement of lost wages. Commercial auto is the value of the vehicle or the physical damage coverage and the use of the vehicle, Part of the exposure basis means how much vehicles are used. A truck that sits in the garage for many months at a time would not pose as big a risk as a truck that is in use on the highways, so that does make sense. With umbrella coverage, since the umbrella is over other underlying coverages, the exposure is based on the percent of the underlying premiums, which does make sense. With employee dishonesty, the exposure is based on the number of employees overall and the number who control cash and checks, and the limit that you select. This is one of the best examples of a very responsive exposure basis. The more employees you have, and especially the more who control cash and checks, the higher your exposure to employee dishonesty. Similarly, looking at directors and officers' liability, the strength of your financial statements and the number of your shareholders and the limit selected should be reflective of your exposure. So remember, when asked about the validity of insurance rates, you need to think about, are these stable, responsive to change, and are they simple? And do these reflect differences in exposure, and do they promote loss control? As we just went through those different rates from AHT Insurance Company and the basis for exposure, I answered many of these questions. For the exam, you should be prepared to answer them in your own words. Now let's look at rate-making components. This will be review for the most part. Rate-making components consist of prospective loss cost, or the cost of losses in the future, which is of course based on the loss, but also the loss adjustment expenses, or the cost of adjusting those claims, which could include legal defense cost and investigations costs. Additionally, there's an expense provision, which of course includes the cost of acquiring the policy in the first place, the commissions and the overhead that went into marketing the policy and distributing it, and other overhead costs such as processing the policy, the billing, and taxes. Then profits and contingencies. Remember that an insurance company's profit is also a contingency, because if the insurance rate is set too low, the insurance company will use that excess to pay for those unexpected losses. If the estimates are good or better than expected, then this will mean an underwriting profit to the insurance company. But what about investment income? The impact of investment income on reserves, and therefore rates, will generally be greater with liability lines than property lines. This should be intuitive since the insurance company holds on to the insurance premium and has longer to invest and make a return on premiums in the liability sector than they do in property lines of business. So investment income matters more when setting rates with liability than property. Let's look in general at the factors that affect rate making. First, of course, the estimation of losses. Insurance rates are based partly on what are called incurred losses, which we discussed earlier in the semester. Incurred loss estimates are based on paid losses, reported but not paid losses, and of course, incurred but not reported losses. Paid losses, of course, are the most certain of the three. Reported but not paid losses may still be somewhat uncertain, but of course, the most uncertain are the incurred but not reported losses. Also, another term you should be familiar with is ultimate loss. The ultimate loss is the final amount paid for all losses in an accident year. We'll talk about the phrase accident year in a moment. In the end, rates will be based on the ultimate loss. Another factor that affects rate making is the delay in data collection and use. Let's look more specifically at these. Delays in data collection and use are caused by delays by policyholders in reporting loss, the time required to analyze the data and use it to make determinations about rate changes, delays in obtaining state approval of filed rates. As we've said before, state rate regulation can vary from prior approval rates all the way to open competition. As you would expect, prior approval rates take the longest. And the time required to implement new rates. Systems have to be adjusted, and those changes have to be fully implemented in order for rates to be effective, and the time period during which rates are in effect. So when it's determined by the insurance company that a new rate needs to be applied, they can only apply it to those policies that are renewed after the rate change. Some policies might have as much as almost 12 months left before new rates can be applied. So your earned premium on those policies will be based on the old rates. Other factors such as regulatory changes and inflation might also cause delays in data collection and implementation. These delays in data collection and use can be very costly to an insurance company if they're extended. Also, changes in the cost of claims affect rate making. In general, in property, the cost of repairing or replacing property goes up every year because of just natural inflation. This is also true for liability, both bodily injury and property damage liability. But it can be especially volatile in the liability area, with changes in public perception of pain and suffering and punitive damages, and in some cases regulation, which often limits punitive damages and pain and suffering claims. Also, the insurer's projected expenses might change rates. Technology has made the claims process, for example, much more efficient and in most cases cost less. And finally, the target level of profit and contingencies. Especially for a publicly traded insurance company, the expected profit of its owners changes depending on the average profit for other investments. So while in one year the target level of profit might be 12%, in another year it might only be 10%. Now let's look at rate-making methods. First, we'll talk about the pure premium method, then the loss ratio method, and then the judgment method. Let's start with a look at the pure premium method. When using the pure premium method, you will calculate the rate that should be charged. This is different from the loss ratio method, where you calculate the rate change. So, how do you calculate the rate using the pure premium method? You will calculate the rate per exposure unit. So the actual premium will be the rate times the number of exposure units. The rate per exposure unit under the pure premium method is the pure premium times 1 plus an expense factor divided by 1 minus the profit and contingencies factor. As an aside, in the textbook, expenses are expressed as an amount, whereas here we'll express it as a percentage of premium. Expressing expenses as a percentage is more common. So what is the pure premium? The pure premium is the incurred losses divided by the number of earned exposure units. The pure premium specifically is the amount of the premium that pays for the losses. You should know how to calculate this. So let's look at an example of calculating the rate using the pure premium method. Let's assume your incurred loss was calculated as $500,000 and your exposure units were 500. The pure premium, therefore, is 500,000 divided by 500, which gives you a pure premium of $1,000. So the rate equals the pure premium of 1,000 times 1 plus the expense ratio. Let's assume the expense ratio is 30%. So 1 plus 0.3 divided by 1 minus the profit or contingencies factor. Let's say that the profit this company wants to generate equals 12% or 0.12. So this equals 1,300 divided by 0.88 or 1,477, and we'll round it to 0.27. That is the rate per exposure unit that should be charged for this type of insurance using the pure premium method. Now let's look at the loss ratio method of calculating the rate change. So this will calculate not the rate itself, but the appropriate change. This is the actual loss ratio minus the expected loss ratio divided by the expected loss ratio. The actual loss ratio is incurred losses divided by earned premium, and the expected loss ratio is 1 minus the expense and profit provision. Note that the expense and profit provision is sometimes just called the expense provision. but in this case, it does include the desired profit and a cushion for contingencies. And again, you should know how to calculate this. So to calculate the indicated rate change using the loss ratio method, we're going to start by assuming that the expense ratio equals 30% and our profit provision equals 12%. So our expected loss ratio equals 1 minus 0.3, the expense ratio, minus 0.12, the profit provision. So that equals 0.58. Now we calculate our actual loss ratio, which equals our $500,000 of losses divided by earned premium of $800,000, which equals 0.625. So our calculation is the actual minus expected divided by the expected loss ratio for an indicated rate change, which equals 0.625 minus 0.58 divided by 0.58, which equals 0.045 divided by 0.58, or 0.07759. And we know that this needs to be a rate increase, first because this number is positive, but it also makes sense because our actual losses were greater than our expected losses. So we have an indicated rate change up approximately 7.8%. And that's an example of using the loss ratio method to calculate the indicated rate change. The last rate-making method is the judgment method. This is the oldest method, but the least often used. This is basically used only when there's not enough data to support other methods. It requires the experience of a seasoned actuary or underwriter to make a determination about the appropriate rate for a risk that is usually unique. Again, where there's not enough data to support another method. So this is common in aviation, ocean marine, and other non-standard insurance lines of business. Now let's look at rate-making data development. These are basically the different steps to developing data for rate-making purposes. The first step is, of course, to collect the data. There are 3 different methods of collecting data. The first is the calendar year method. Next, the accident year method, and then the policy year method. Let's look at each of these individually. The calendar year method estimates both earned premiums and incurred losses by formulas from accounting records. This is the easiest to calculate, but the least accurate. Let's look at an example of how accounting records are used to collect data under the calendar year method. The formula that's used to calculate earned premium equals beginning of year premium reserves, which are the amount of reserves that have been set aside for premium that was written before the beginning of the year but will be earned over the year, assuming 1-year policies, plus written premium, so this is premium written in the current year, minus end of year premium reserves. This is because the reserves that are still in the premium reserve account at the end of the year have not been presumably earned. This assumes that the accounts are correct and doesn't necessarily take into account canceled policies. The formula for losses incurred can be even more problematic. Calculating losses incurred using the calendar year method, you take end of year loss reserves, which are loss reserves that are still in the reserve account at the end of the year, plus paid losses, losses that were paid over the year, minus beginning of year loss reserves. This makes sense if you assume that the beginning of year loss reserves are reflective of all losses that occurred before the current year but have not been paid yet. So by subtracting those out, you're subtracting out any losses that were paid or that are currently in loss reserves from losses that actually occurred in a prior year. This assumes that the loss reserves, both at the beginning of the year and at the end of year, were an accurate reflection of the actual losses that occurred. This assumes that actuaries always accurately predict loss reserves, which is not a reasonable assumption. This is why the calendar year method, while it's relatively easy to calculate, is the least accurate. Now let's turn to the accident year method. The accident year method uses incurred losses for an accident year, which consists of all losses related to claims from that year, but estimates earned premium using accounting records like we did in the calendar year example. Using the accident year method of data collection, it's incumbent upon actuaries and underwriters and other personnel involved to specifically tie losses paid and loss reserves back to the years in which the losses actually occurred. This makes sense because you want to make sure that the premiums paid in those particular years are tied only to the losses that occurred in those years to get an accurate loss ratio. This is actually the method that's used in U.S. statutory insurance accounting for losses, or Schedule P. We'll look at an excerpt from Schedule P in a moment. And last, the policy year method. This analyzes all policies issued in a given 12-month period, which links all losses, premiums, and exposure units to the policy to which they are related. So this is the most difficult method to calculate, but it is the most accurate. This is the method required in London and in many European countries. The next step is to adjust the data. Let's look at some specifics about adjusting data for rate-making purposes. The first step is to apply loss development factors. In your PDF, you'll note that you will be responsible for examples of loss triangles. Let's look at one. This is an excerpt from Schedule P, which is part of the statutory insurance financial statements. You'll notice on this page that there's a triangle for each business that the insurer writes in. This is an actual Travelers Company Schedule P. Let's zoom in and look just at the homeowners triangle. First, notice that these that I've circled here are the years in which losses were incurred. These are the years losses are tied back to. This is how accident year accounting occurs, by using these loss development triangles and developing losses over time. The most recent year, the 10th column, for 2011 in this case, has the most accurate data for the years in which losses were incurred up until that point. And specifically, the most accurate year's data would most likely be for 2002, since that year has been developed for 10 years. Also notice the development numbers in columns 11 and 12. Column 11 is the difference between column 10 and column 9. Notice the numbers here, and these are in millions. 36.233 million minus 35.671 million is 562. That's the amount of development that occurred in the last 2 years. Then look at column 8, where you see 35.894 million. That number taken from the current year of 2011 equals 339. And obviously these numbers are rounded, so there is a bit of a difference. These development factors show how the insurance actuary's estimates have changed over time, and they should change less and less from year to year, unless there was a significant error in judgment. So essentially, this shows where actuaries were wrong in their loss estimates. And as more information comes in, and as losses are paid, they adjust their estimates to reflect reality. The next step to adjusting data is to apply trending. Looking back at our Schedule P triangle, the trending would actually occur going down the column. Notice that, as you would expect, in most years, the amount of losses goes up. Now, since this is not relative to premium, we don't necessarily know if the losses go up because of a higher premium base or because of inflation. Once these losses have been fully developed, we would have to take them relative to premium to determine what the actual trend is. But it is not surprising to see losses increasing over time. Most losses do increase over time just because of inflation. You should know the difference between linear and exponential trending. Linear trending is just an expected increase in losses by a specific amount or dollar figure each year. So I might say that losses on commercial auto increase by $1,000 per year. Exponential trending is saying that losses increase by a certain percent each year. And since you multiply by the percent every single year, that number becomes exponential. Most losses increase by an exponential trend since inflation is usually a percentage. The next step in rate-making data development is to determine territorial and class relativities. Since when calculating rates, companies will tend to look at an aggregation of all losses or an adding up of losses, this would give you an inaccurate estimate of rate changes if you apply the same change to every class or territory. For example, if you added up losses in Louisiana after a hurricane and applied the exact same rate change to each territory, this would be unfair and would not appropriately reflect risk. Next, you should prepare the rate filings. In most states, you will have to file the rates, whether it's a prior approval, file in use, or use and file state. Lastly, let's discuss other important rate-making concepts. First, experience period. This is essentially the idea that different lines of business require that you look at different experience periods to determine rate changes. For example, an experience period of 1 to 3 years for property damage auto insurance is not unreasonable, but an experience period of 1 to 3 years for pollution liability or coastal property insurance would not be appropriate, given that you might have spike losses in some years. So if you're basing rates on just 3 years and there hasn't been a hurricane, then your rates will undoubtedly be low. Next, large loss limitations. Related to what we were just discussing, unusual rate fluctuations could occur because of large loss fluctuations, or spike losses. A common example of this would be a catastrophe. Another would be an unusual liability loss, such as a significant pollution lawsuit for a company. Most losses from these types of large events or accidents are excluded from rate-making data and replaced by a flat amount and spread out over different states. That doesn't mean that a non-coastal property owner should pay the same rate as a coastal property owner, but to some degree, large losses, catastrophic losses, are spread over a broader portion of the pool. You've heard me discuss the CAT load or catastrophe load before. This would fall under the category of a large loss limitation, and a catastrophe load is added separately. Last, credibility. Credibility of data is a measure of the predictive ability of data. This relates in part to class and territorial relativities, as well as experience period. You want to make sure that the underlying data not only looks over a long enough span of time, but also the loss experience is reflecting the experience of the population to which you're going to apply the new rates. In other words, you wouldn't use accidents caused by texting and driving from 1995 and apply those loss experiences to 2017. And that's the end of our discussion of actuarial operations.